Back to discussing financial matters in this video. The Wall Street Journal published an article earlier today titled, quote, "When High-Yield Savings Accounts Come with an Asterisk," end of quote. The article summarized what some banks were doing with what they call high-yield savings accounts. The primary focus of the article was a bank called UFB Direct. After the Fed started to raise the federal funds rate, savers started to look around for a higher yielding savings account than what was being offered by their local banks. UFB Direct had advertised in the early stages of those rate increases a 1.81% interest rate, which was high among competing offers at that point in time. And anyone who deposited money probably thought that they would get the benefit of increases in the federal funds rate through that savings account, which proved not to be the case. The savers were locked in at that 1.81% rate. A few weeks after offering that, UFB Direct offered a 2.15% for those who deposited funds in another savings account that they called Reward Savings. So they just changed the name of the account, but you had to ask for that account to get that rate. The people that had the other account only got 1.81%. Those customers were then stuck at 2.15%. Even though the Fed continued to raise the federal funds rate and savers at institutions which had just one savings account and they would continue to bump up the interest rate, but not for those who had opened an account at this particular bank. Even though the Fed continued to raise rates, the bank started 8 more savings accounts as those federal funds rates started to go up, calling them names like savings, preferred savings, priority savings, and finally secured savings, which if you were fortunate enough to wait until they offered that one, you would get 5.25%. I would not give that bank a dime. Many of the CDs that are offered at brokerage firms allow the issuer to call before maturity. For a 1-year CD, the call period may be after 6 months or so, for example. That only matters when rates are falling and the issuer is better off calling the CD and reissuing it at a lower rate. But the investor, under those circumstances, would be worse off since the proceeds can only be reinvested at a lower coupon given the decline in rates. You need to pay attention to these kind of bank gimmicks that only work for them and not their customers. States cannot tax interest paid by U.S. Treasury bills, notes, and bonds, something that I've discussed on many occasions here, provided they are owned directly by the individual. I live in Tennessee, which has no individual income tax. States with income taxes may tax CD interest, making the after-tax return less than a comparable maturity Treasury. Since Treasury bills are yielding more than most CDs at the moment, the after-tax disadvantage of CDs is even worse when a state taxes that interest. Another issue may impact those who live in states with income taxes. The investor may think that dividends paid by Treasury money market fund will be exempt from state taxes, and that may not be the case. Many of these funds use what is known as repurchase agreements, and states will tax income originating from those investments even when the repurchase agreement involves a U.S. Treasury. That is sufficient to take it out of the supremacy clause argument that the Treasury has, that the states, being a lower sovereign, cannot tax its interest. The states can tax interest derived from repurchase agreements, even if they involve treasuries. And this can even be made worse in some states because they have a threshold amount, which if the income goes over the threshold amount from repurchase agreements, the entire dividend paid by that fund during a year is taxable, even though they may own significant amounts of treasury bills directly. Three of my brokers, Vanguard, Fidelity, and Schwab, do not charge a commission for U.S. Treasury trades. These purchases are $1,000 par value per security. Less can be invested through a Treasury Direct account that many have set up when they bought I-bonds from the Treasury. The 3 and 6 month bill auctions occur on Monday, the 4 month on Wednesday, the 1 and 2 month on Thursday. The 1 year auction is held monthly. I participated in that and discussed it in my last blog. I place a non-competitive bid, which will be filled at the best price established by the competitive bids. I will also participate in the 2-year Treasury note auction on February 26, but not the 5-year note on the same day, nor the 7-year note that will be auctioned on Tuesday.